However, a factor you must take into consideration when evaluating today's less established technology companies. Warren Buffett's portfolio of consumer products and consumer cyclical stocks shows his preference for high, consistent ROEs. Coca-Cola and Gillette, for example, have steadily posted yearly ROEs between 30 and 50%, an astonishing record for companies that have existed for decades. Nearly all the other public companies in which Buffett owns large stakes boast average yearly ROEs of 15% or better. By virtue of their high internal returns and lower-than-average capital needs, these companies have managed to generate high returns on shareholders' money year after year and post earnings growth of between 10 and 20%. Chapter 10. Buffett's Magic 15% Rule. Warren Buffett knows that when a company delivers consistent earnings growth of, say, 10% a year, one can also expect consistent share price growth. In fact, for many companies, there is a nearly 1-to-1 correlation between long-term growth of earnings and growth in stock price. Companies that have increased earnings by 12% a year over long periods have likely seen their share price grow at annual rates close to 12%. Put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value, Buffett said in 1996. Whether you get exactly 12% or more or less than 12% depends on two factors: the ability of the company to maintain its consistency and the price you are willing to pay for that consistency. If the public grossly overprices a company's earnings stream, the rate of return you can expect will likely not exceed the growth in earnings. Consider what happened to Procter & Gamble in the 1970s. The stock traded for more than 50 times earnings before peaking in late 1972, although earnings were marching upward at only 12% annual rates. Procter & Gamble stock fell steadily during the next several years, despite the fact that earnings tripled. In essence, Procter & Gamble's P/E ratio contracted. By the early 1980s, Wall Street had hung such a low price tag on Procter & Gamble's earnings that its rate of return potential was unbelievably alluring. Procter & Gamble continued to produce stellar earnings during both bear and bull markets of the 1970s and 1980s, but the rate of return depended significantly on the price paid relative to earnings. Before Buffett buys shares of a company, he makes sure the stock is capable of returning at least 15% a year for him over a long period. 15% is the minimum return Buffett requires to compensate him for inflation, the inevitable taxes from the sale of the investment, and the risk that taxes and inflation will rise in the ensuing years. For example, if a stock you bought delivers a 10% annual return, you'll likely lose 2 to 4% to inflation. You may lose 31%, possibly more, of your gains to federal taxes. In addition, you need a return well in excess of long-term Treasury bonds to compensate you for the extra risk you take on by owning stocks rather than bonds. There's no disputing that getting 15% a year is possible if you buy the right companies at the right prices. Conversely, it's possible to buy into great businesses and get inferior returns because you chose the wrong price. It's possible, too, to enjoy extraordinary returns from good and poor businesses when buying at the right price. Most investors don't realize that price and returns are linked. The higher the price, the lower the rate of return potential, and vice versa. It's that simple. By late 1999, the rapid rise in stocks had severely diminished the long-term rate of return potential of many great companies. To determine whether a stock can get him 15%, Buffett tries to estimate where a stock might trade in 10 years based on its earnings growth rate and average P/E ratio, and compares it to today's price. If the future price plus expected dividends doesn't equate to a 15% annual return, Buffett is inclined to forget it. By applying Buffett's simple calculations, you would logically avoid most of today's popular stocks until they fell further in price. This exercise hammers home an important point. The price you pay determines your potential rate of return. You will always get a higher rate of return buying General Electric at $80 rather than $120. When Coca-Cola peaked at around $89 in the middle of 1998, it traded for more than 60 times its yearly earnings. At the time, Coke was trumpeted by most brokerages and leading fund families as a can't-miss growth company. The trouble was, no one bothered to peg Coke's stock price to future performance. Even if Coke sales didn't suffer, at a price of $89, the stock was destined, perhaps doomed, to provide negative returns to new investors. When Walt Disney peaked in 1999 at $43, the expected rate of return over a 10-year period was just 0.5% a year. Given Disney's expected earnings, the stock would have to trade for $11 to secure a good chance of delivering 15% a year. If you wanted more than 15%, you would have had to buy below $11. Drugstore chain Walgreens offered the same abysmal return when it peaked in 1999 at around $45, or 48 times its earnings. By applying the formula, Walgreens would have had to fall to $12 before it offered a high probability of delivering a 15% long-term return. At $45, however, there was a distinct chance that Walgreens would deliver almost no gain over the next decade. Gillette would have had to fall another $16 to $22 before it cleared Buffett's hurdle rate. American Express would have to be cut in half. The most predictable value destroyer among all the popular large-cap stocks was Charles Schwab, which, when it peaked at $52, after splitting 3-for-1, offered a nearly guaranteed negative return for new buyers. Given Schwab's presumed growth rates, an investor could not hope to get a long-term 15% return until the stock fell almost 80% to around $11 after the split. These figures are difficult to swallow, but nonetheless telling. When you buy a stock that has already rallied several hundred percentage points in recent years, the rate of return potential going forward can be pathetically poor. Nevertheless, many investors assume that past results can be duplicated. They keep buying stocks such as Dell Computer or Qualcomm, thinking they can rise 60-fold again over the next 5 years. Nothing reduces the rate of return potential more than overpaying for a good company. As Peter Lynch once said, "It's a real tragedy when you buy a stock that's overpriced, the company is a big success, and still you don't make any money." Chapter 11. Putting Growth in Context. Warren Buffett would be the first to admit that no one, including himself, can accurately pinpoint the value on a company. 50 different analysts, each studying the same data, could come up with 50 different valuations for an enterprise, even ones as predictable as Walgreens and Merck. Theoretically, their estimates should be reasonably close, but that rarely happens. A rigorous analysis of a company, for example, may involve more than 100 inputs and variables, many of which are based on the analyst's hunch or estimate. Changing one or two key assumptions, such as growth rate, market share, or interest rates, causes an abrupt change in value. Buffett recognizes this inherent weakness in valuation, and in its place substitutes a common-sense principle: you'll know value when you see it. At the 1996 annual meeting, he admitted that he rarely applies hardcore valuation techniques when researching stock ideas. If the value of the company doesn't just scream out at you, it's too close. Indeed, most investors have preconceived intuitive notions of value before they buy an asset. A home buyer, for example, may not be able to value exactly a 4,000 square foot Georgian home in Beverly Hills, but at a price of $750,000, he knows it's a steal. Similarly, if American Airlines lowered the price of a round-trip ticket from New York to Paris to $199, you'd recognize the value immediately. Likewise, you may be indifferent to Nike's stock at $50 per share, but you know that it's a bargain at $25. Suffice it to say that by late 1999, Buffett could find few screaming values left. In his mind, Beverly Hills-like stocks were fully priced and offered subpar rate of return potential. Oftentimes, a little common sense will let you determine whether a stock is a screaming value or whether an outrageous price has robbed the stock of all future appeal. Textbooks tell us that a company cannot be worth more than what investors can take out of it in earnings. In other words, if a company is expected to earn a sum total of $10 billion in profits from here to eternity, after adjusting for inflation and risk, shareholders should be willing to pay $10 billion today to own all the stock. Thus, if Amazon.com stock sells for $25 billion in the marketplace, as it did in early 2000, investors are betting that the present value of Amazon's future earnings will be $25 billion or more. If Amazon's earnings stream proves to be far greater than $25 billion, Amazon will be a screaming value. If Amazon can never earn $25 billion, its stock is grossly inflated. The question to consider, then, is whether $25 billion is a reasonable number or whether it grossly inflates the company's true potential. By using valuation templates found on the Internet, such as Stock Evaluator, an intrinsic value calculator hosted by www.quicken.com, investors can quickly assess whether the market's current valuation of a stock is on target or off base. Stock Evaluator spits out a hypothetical value of a company based on growth rate assumptions users can plug in when they visit the site. It provides an effective tool for finding out the maximum you should be willing to pay for a company, given the current level of interest rates, the company's past and future growth rates, and your rate of return criteria. An investor can use intrinsic value tools such as Stock Evaluator in two ways. First, the real value of these tools is that they can provide a reasonable price range for buying. If data indicates a company is worth $50 per share, you should probably avoid the shares if they currently trade at $100. Conversely, if the stock trades for $25, extra investigation is warranted. Second, you can use Stock Evaluator to spot-check the market's current valuations, especially for popular technology stocks. Because it is difficult to estimate a company's future growth rate, Stock Evaluator allows you to take an indirect approach. You can start with the current stock price and determine the long-term growth rates necessary to justify that price. In other words, rather than question whether a stock is worth, say, $100 per share, try to determine what growth rate is necessary to make the company worth $100. Welcome to the United States of Yahoo and Cisco. In February 2000, I screened 200 of the largest U.S. companies to determine whether the market was correctly assessing these entities' future prospects. Using a discount rate of 15%, I asked Stock Evaluator's computer to determine what perpetual growth rate was needed to justify these companies' stock prices. A few companies passed the test easily, indicating that they were worth at least the current value of their stock. Beleaguered tobacco maker Philip Morris, for example, would have to exhibit a meager 3% growth rate in earnings perpetually to justify its washed-out $21 share price. Philip Morris's earnings, by the way, had grown at 16% annual rates since the late 1950s. Therefore, the market was assuming that Philip Morris's historical growth rate would slow by more than 80%. The stock peaked at almost $57 in late 1998. In pushing the shares down to $21, the market was either correctly assessing Philip Morris's future or was selling shares in panic. Abbott Laboratories, the pharmaceutical and medical products company, would have to grow at 7% annual rates to justify its February 2000 price of $33. The stock slumped more than $20 at the end of 1999 over near-term concerns about its drug development pipeline. Like Philip Morris, Abbott had exhibited 16% growth rates during the 35 years leading up to 2000, more than twice the growth rate investors were estimating when they drove the stock to $33. Retailer J.C. Penney found itself in a similar pricing squeeze to begin the new millennium. Based on a price of $18 per share, the company would have to grow at modest 6% annual rates to justify its price. Since 1960, Penney's earnings had grown at compounded 9% rates. But these stocks were the exception rather than the norm. Prices for many of Wall Street's favorite stocks assumed growth rates beyond belief. The most grossly overvalued stock was Yahoo, the internet portal that traded for $360 in February 2000. At the time, Yahoo had about $600 million in sales, and the company was beginning to report quarterly profits, but the market was valuing its stock at $90 billion, almost twice the market's appraisal of Philip Morris. Assuming a 15% discount rate, Yahoo would have to increase its earnings at 63% yearly rates for the present value of earnings to equal $360 per share. That figure assumes that Yahoo will maintain the same number of shares outstanding perpetually. For argument's sake, assume that Yahoo will increase sales at a 63% annual rate, a reasonable assumption because corporate earnings growth tends to track sales growth over long periods. By 2020, Yahoo sales would be more than $10.3 trillion. Assuming the U.S. economy continued to grow at 3% rates after inflation, Yahoo's 2020 sales would constitute 64% of the U.S. economy. If memories from biology class serve me right, not even paramecia multiply at that sustained rate. Sounds far-fetched, doesn't it? But a buyer at $360 a share unwittingly placed his faith in Yahoo attaining $10 trillion in sales someday. Any level short of $10 trillion guaranteed that the stock would eventually lose money if an investor held it long enough. After all, as Buffett has pointed out, a stock cannot be worth more than the earnings it will generate for investors. At the height of folly, Berkshire Hathaway Vice Chairman Charlie Munger once said, "People will stretch their belief systems to justify virtually anything." In self-appraisals of prospects and talents, it is the norm, as Demosthenes predicted, for people to be ridiculously over-optimistic. Munger told an assemblage of investment professionals in 1998. For instance, a careful survey in Sweden showed that 90% of automobile drivers considered themselves above average, and people who were successfully selling something, as investment counselors do, make Swedish drivers sound like depressives. Virtually every investment expert's public assessment is that he is above average, no matter what is the evidence to the contrary. Cisco Systems emerged as the second most wildly appraised stock, according to Stock Evaluator. To justify its $124 share price, Cisco's earnings would have to grow at 39% rates year after year. Many investors must have thought a 39% growth rate was feasible, despite the fact that no entity in world history has ever attained such a feat. Mathematics reaffirms that Cisco could not keep up the pace of growth. If Cisco's sales grew at 39% rates, for example, the company would boast $8.8 trillion in revenues by 2020. This would imply that Cisco's output would constitute 55% of the U.S. economy in 20 years. Combined, the sales of Cisco and Yahoo would exceed total U.S. economic output by $3 trillion. Imagine an economy made up of just two companies. Stock Evaluator showed that investors were presuming that Qualcomm, the telecommunications equipment company, would increase earnings at 46.5% annual rates when its stock traded at $140 in early 2000, after adjusting for a 4-for-1 split. Interestingly, Qualcomm had lost about 30% of its value in the weeks before this chapter was completed, yet even at a reduced price, Qualcomm was no bargain. Using the same projections made for Yahoo and Cisco, we can see that the $140 price tag implied $8.1 trillion in sales by 2020, fully 51% of the U.S. economy. The price of Walmart implied that the retailer would grow to be 33% of the economy by 2020. Motorola's hefty $155 price tag implied $5 trillion in sales by 2020. General Electric would have to attain almost $3.1 trillion in sales by 2020 to reconcile its $136 share price. America Online would be 1/10 the size of the economy, as would Oracle. Walt Disney would have to grow at 22% annual rates and constitute 8% of the economy. Amazon.com needed $4.5 trillion in sales to ensure that its $75 price in early 2000 was worth it. Extended bull markets, you see, tend to obscure logic. Price and value become irrelevant, and investors increasingly chase momentum, thinking that everything must continue to rally at rates beyond reason. Put these numbers in perspective. If the growth rates uncovered by Stock Evaluator were correct, the U.S. economy would one day consist of just a handful of companies, with Cisco, Yahoo, and Qualcomm consuming the bulk of our economic output. Keep in mind that a great deal of their sales come from overseas. Throw in Microsoft, Motorola, Oracle, and Intel for good measure, and there would be no need for any other employer to exist. We could all work for one of 7 technology companies. If you believed in such a rosy future, you were buying these stocks in early 2000. Buffett didn't and kept his money at bay. On this issue, Benjamin Graham articulated it best. This concept of an indefinitely favorable future is dangerous even if it is true, because even if it is true, you can easily overvalue the security since you make it worth anything you want it to be worth. Beyond this, it is particularly dangerous too, because sometimes your ideas of the future turn out to be wrong. Then you have paid an awful lot for a future that isn't there. Your position then is pretty bad. Chapter 12. Coveting Moats. The Quest for Stability. During regular visits to local McDonald's restaurants, I made it a point to read quota sheets the company posts on the back wall for its employees. The sheets totaled the number of orders placed for the day and itemized the number of orders that came from walk-in customers or from the drive-through line. Over a year's time, I noticed that the numbers were remarkably consistent. With the exception of holidays or certain Sundays, roughly the same number of customers ate at these select franchises each and every day. Just as predictably, between 68 and 70% of each day's customers ordered their meals from the drive-through line. Consistency, you see, is the mother of capital gains. Before its dining concept began losing its appeal in 1998, Cracker Barrel Old Country Store posted one of the more outstanding growth streaks in restaurant history. Earnings and sales grew at 15 to 20% rates for more than a decade, and the stock rallied in tandem with the growth in earnings. Consistency played a key part in Cracker Barrel's success. The average Cracker Barrel restaurant turned its table more than 8 times a day, meaning that the average seat in each restaurant, there are usually 175 to 200 seats, was occupied by 8 different people over a 24-hour period. No other restaurant turned its tables that often. As a result, the typical Cracker Barrel store could boast sales of between $3 million and $4 million a year, more than a McDonald's franchise attains. As a private investment, Cracker Barrel's stores were a gold mine. Because the company could seemingly count on 8 table turns a day, no matter the location of the restaurant, new Cracker Barrel locations could attain returns on an investment of 30% a year or more. That is, for every $1 million invested by Cracker Barrel building a new store, it could expect at least $300,000 in operating profits every year. Warren Buffett craves consistency because consistency helps remove risk from a stock portfolio. Research has shown that a consistent track record of performance tends to result in consistent share price growth. A company with a long track record of stable performance is much more likely to have a stable stock price than a company whose growth streak is pockmarked with sharp gains and losses. Inconsistent business performance is the bane of all investors. A company whose earnings growth fluctuates wildly over time, such as General Motors, Alcoa, Schlumberger, or Sears, will produce a trading pattern that resembles a roller coaster. During periods of rapid earnings growth, these stocks will ascend rapidly. Sooner or later, however, the company can no longer maintain its growth streak, and investors flee in droves. What results is an up-and-down share price where rallies of a year or two are followed by prolonged periods of decline. These types of earnings fluctuations can sometimes produce no net results for investors over long periods. When Sears Roebuck stock fell back to around $30 at the end of 1999, it traded for roughly where it did in 1972. By late 1999, General Motors traded about $15 above where it did in 1972. The decline in Schlumberger's stock in early 1999 brought the price back to the level it reached in 1980. Because these companies were never able to increase earnings consistently, their share prices bounced up and down in a large trading range for 2 decades or more. Along the way, they periodically fooled investors into thinking that consistent growth was at hand. Buffett chooses companies with consistent track records so he can remove as much stock price risk from investing as possible. He knows that if a company can deliver, say, 15% earnings growth year after year, the stock price will not show the level of intra-year gyrations common to most other stocks. Occasionally, these stocks will rally above the company's intrinsic value, in which case Buffett is likely to continue holding. On occasions when these stocks fall sharply in price, Buffett may go into the market and purchase more shares. In general, he will maintain his investment in the stock until it becomes apparent that the company's ascending legacy of earnings has been broken. The classic case is Coca-Cola, which went public in 1919. We have had depressions, we have had wars, sugar prices have gone up and down, a million things have happened. How much more fruitful is it for us to think about whether the product is likely to sustain itself and its economics than to try to be questioning whether to jump in or out of the stock? Minimizing share price fluctuations is crucial to great investors such as Buffett. Fluctuations cause most investors to rethink their strategy. Most investors are prone to fixate on share price as the true measure of a company's success, but not on its income statements or balance sheet. To these investors, a rising price validates that the company is performing well. A declining price triggers the opposite reaction. The temptation is to sell a stock when it begins to decline or turn too volatile. Choosing stocks that won't exhibit much volatility removes the temptation to trade unnecessarily. A proven track record is one important way to attain consistency. By focusing on companies with long and illustrious records of increasing net worth and value for shareholders, Buffett has managed to insulate his portfolio from broad fluctuations in value. The few occasions in recent years in which Buffett was susceptible to abnormal price fluctuations occurred when investors bid Buffett stocks to unprecedented valuation levels. Coca-Cola traded at more than 60 times earnings at its 1998 peak, and Walt Disney and Gillette traded for more than 40 times earnings throughout 1998 and 1999. All 3 stocks, in retrospect, were destined, some say doomed, to give back a large portion of their previous gains and post inferior stock performance, but rarely has Buffett made the mistake of owning a company that simply did not perform to his or the market's expectations. A company's track record can take a stock only so far, however. The second, equally important way to remove stock price risk and avoid abnormal price fluctuations is to own companies whose future can be quantified and predicted with some degree of accuracy. Because stock prices reflect an enterprise's forward earnings more than past earnings, it's important for investors to fixate first on companies able to project and carry their consistency into the next decade and beyond. Understandably, chasing posterity creates a conundrum for investors. Very little can be said of the future. The majority of U.S. companies and industries, in fact, will undergo major transformations over the next 10 to 15 years. Investors don't know, for example, how the economy will perform going forward, whether interest rates will rise or fall, or whether the U.S. dollar will catapult higher or collapse. Moreover, we cannot predict how the pace of technological and productivity change will alter the business climate. Today's popular industries may wither away within 5 years. The very technology stocks that Wall Street praises today as no-brainers may find their technological advantages overshadowed by new yet unknown competition. The current pace of technological change and the pace of productivity improvements are outstripping investors' abilities to analyze that change. Investors who are not mindful of this sobering certainty will find themselves misled into poor choices. We think new technology is very beneficial from a societal standpoint. Our own emphasis is on trying to find businesses that are predictable in a general way as to where they'll be in 10 or 15 or 20 years. That means we look for businesses that in general aren't going to be susceptible to very much change. We view change as more of a threat investment-wise than an opportunity. That's quite contrary to the way most people are looking at equities right now. With a few exceptions, we do not get enthused about change as a way to make a lot of money. We're looking for the absence of change to protect ways that are already making a lot of money and allow them to make even more in the future. Older investors certainly can recall the mid-1980s when the hottest technology stocks were hardware and software companies such as Kaypro, Corona Computers, Grid Systems, Mohawk Data Sciences, and Commodore. All were touted by the financial industry as surefire ways to play the almost certain boom in personal computing. All fizzled faster than a bottle of warm diet root beer. At their peaks, they traded at P/E ratios in excess of 100. By mid-1999, Warren Buffett came under intense criticism in the media for maintaining a stodgy posture and avoiding the high-flying NASDAQ stocks that had provided investors extraordinary gains the previous 2 years. His purposeful avoidance of technology stocks in particular was derided in financial magazines and on chat rooms. "When is he going to wake up and smell the roses?" one hedge fund manager told me over the phone. "He's got to get with the program because technology is the place to be." Internet chat rooms were equally harsh on Buffett's buying habits. "His days are over. He belongs in the previous century," said an anonymous posting on Yahoo. Buffett held his ground throughout, pointing out that although technology was consuming an ever larger slice of the American economy, the group still seemed to lack the predictability that prudent investors require. If a company's future cannot be predicted, Buffett said, it cannot be valued. If a company cannot be valued, there is no indisputable way of ensuring a positive return on one's investment. A company whose future is totally unpredictable may be worth $200 per share or just $2. No one will know until after the fact whether the stock's current price was on the mark or a grave error. I'd probably take an internet company and ask students, "How much is it worth?" And anybody that gave me an answer, I'd flunk. Buffett told shareholders in 1998. If the new paradigms on which today's stock prices are based eventually prove faulty, is there anything on which investors can truly rely? Yes, says Buffett. A number of companies have grown their core businesses for decades with few cyclical interruptions. Given the steadiness of their businesses, we can reasonably assume these companies will function similarly for the next several decades and continue to provide steady gains for investors. Coca-Cola has been in the same business, selling syrup, for more than 100 years. Its core strategy will likely never change. Close your eyes for a decade, and you would awake to find Coke doing the same thing it's doing now, only its sales and profits would likely be much greater. Let's say you were going away for 10 years and you wanted to make one investment and you know everything you know now and couldn't change it while you're gone. What would you think about? I would want to know certainty, where I knew the market was going to continue to grow, where I knew the leader was going to continue to be the leader, I mean worldwide, and where I knew that there would be big unit growth. I just don't know anything like Coke. One could say the same for Gillette, Anheuser-Busch, Johnson & Johnson, Harley-Davidson, Tootsie Roll Industries, Wendy's International, Automatic Data Processing, Genuine Parts, William Wrigley, and Hershey. Granted, these companies lack the sex appeal of Qualcomm, Global Crossing, and JDS Uniphase, three of the hottest stocks in 1999, but they continue to deliver the goods for shareholders year in and year out. It is also doubtful that investors will witness any strategic changes at companies such as McDonald's. If the quota sheets at the restaurants are an indication, investors can count on consistent rates of return on their investment. 5 years from now, odds are good that the same number of patrons will walk into a McDonald's restaurant every day and that a high percentage of them will use the drive-through window. In contrast, does any internet stock currently offer even a fraction of the consistency and cash-generating potential McDonald's does? Will any in the future? If not, why have internet stocks such as Yahoo been priced in the market at twice the value of McDonald's? Can anyone say with any certainty what Cisco Systems or Sun Microsystems will look like in 15 years? Will they be in the same lines of business, or will their business models change radically? If you can't envision these companies' futures, make sure you don't ever pay a price that anticipates that far ahead. Stock prices are supposed to reflect all the earnings a company can potentially generate for investors going forward. If earnings cannot be predicted with much certainty, investors have assumed too much share price risk. Companies trading at more than 100 times earnings today must be capable of generating 30 to 40% sales and earnings growth year after year, a mathematical impossibility. Investors sometimes extend their faith to extremes. We hope that our best investments are immutable, that their hot growth streak can continue forever. The truth is that few, very few companies ever enjoy such luxury. Even Microsoft's and Walmart's growth rates have slowed considerably in recent years, as will the growth rates of today's highly touted technology stocks. Some will experience slowing growth much earlier than others. Think back through the 1990s and you'll recall a lot of sure thing trends that fizzled out because investors wrongly assumed the good times would last. Oil stocks were supposed to provide great returns because of constantly increasing demand for crude. Waste hauling stocks were supposed to take advantage of a growing population and a critical shortage of landfill space. Microbrewers and golf club manufacturers were supposed to be wealth effect plays. Medical device stocks were supposed to rise indefinitely because of the growing worldwide need for health care. Health maintenance organization stocks were supposed to be a great way to play the shift into managed care. Wasn't Boston Chicken supposed to be the dominant restaurant for families? Boston Chicken declared bankruptcy in 1999, just 18 months after the stock peaked at around $40 per share. Weren't PC components manufacturers Iomega and Western Digital supposed to have shared in the phenomenal growth of computers? Both were eaten alive by pricing pressures no one predicted. It's not easy, Buffett says, for businesses to grow unimpeded. There are people that are looking at what you're doing every day and trying to figure out a way to do it better, underprice you, bring out a better product or whatever it may be. A few companies make it, but here in the U.S., after all of these decades and decades and decades of wonderful economic development, we still only have about 400 companies that have hit the profitability level that would be required of a company with a market cap of $3 billion. And yet some companies are getting $3 billion of market cap virtually the day they come out. You want to think about the math of all this. The media like to poke fun at Buffett for missing the surge in technology stocks. Forgotten among their excoriations is the fact that Buffett never seems to put his money into losing stocks such as Boston Chicken either. He may have missed the ascent of Microsoft and Intel, but he also avoided countless other technology companies such as Iomega and Western Digital that spent their potential as quickly as a 4th of July sparkler. Unfortunately, in the business world, sparklers greatly outnumber superstars. Blindly putting money into technology stocks is a surefire way to guarantee mediocre returns because few will attain the greatness of a Microsoft. Just ask all the investors in computer stocks in the 1980s. If you had purchased equal amounts of stock of all the computer hardware companies that traded in the mid-1980s, you would have barely broken even as the century ended. The gains in Apple Computer, Compaq, and a few others barely offset the oftentimes horrific losses sustained by the rest. Lacking any knowledge of the future, a mid-1980s investor had to pick and choose winners from a crowded field of sure things, and most lost. Chapter 13. Comparing Stocks to Bonds. Money manager and author Gerald Loeb once remarked that the worst way to combat inflation is to buy assets as a supposed hedge at an inflated price. If you haven't accurately priced in the risk of inflation or the possible loss of purchasing power, you can easily wind up with a great asset that generates negative returns. As an investor, you must strive for self-preservation. The investments you choose should, at the very least, compensate you for the natural depreciation of assets that occurs over time. In addition, investments should bear at least the same rate of return potential as similar assets of similar risk. This concept is vital to accumulating wealth. If your assets cannot keep pace with inflation or the natural rate of depreciation of assets, your standard of living will drop. It is imperative that you pick a portfolio of assets that can appreciate in value faster than their natural depreciation rate. Indeed, the chief economic reason humans invest is to preserve their net worth from the effects of inflation. It was long held that inflation aided investors because it gave companies the latitude to raise prices and report better profit margins, earnings, and returns on equity. Today, inflation is viewed as an antithetical force. It not only lowers the reported value of corporate earnings, but also makes stocks less attractive than other instruments, namely bonds, that are theoretically priced for inflation. Consider this analogy Warren Buffett wrote for Fortune magazine in 1977. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislature. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Buffett views inflation as a mighty economic force that never can be eradicated. Inflation can lie dormant for years, as it did during the late 1990s, but it can never be tamed. As long as governments have the ability to infuse liquidity into an economy or to debase their own currencies, an investor must assume that politicians occasionally, acting in their own self-interests, will take fiscal steps that unwittingly lead to rising prices. Like virginity, a stable price level seems capable of maintenance, but not of restoration, Buffett once quipped. The effects this can have on stock prices are potent. The last surge in inflation in this country in 1994 caused stocks to slump in price for several months. By the end of 1994, after 11 months of sideways trading, many investors had thrown in the towel and had moved their money into bonds. Stocks that a year earlier sold for 20 times earnings were now priced at 8 and 9 times earnings. Rising prices, coupled with Federal Reserve Board actions to raise interest rates, ultimately doomed the 1987 stock market, too. The proximate cause of the one-day 508-point plunge was an unexpectedly large trade deficit. Months before the crash, interest rates had begun rising, causing analysts to revise downward their valuations of common stocks. The prolonged bear market of the 1970s also had its roots in rising prices, which acted as an anchor to dozens of popular large-cap companies that had been bid up to prodigious multiples of their earnings. When inflation rises over an extended period and bond yields rise, P/E ratios of stocks tend to drop. When inflation falls, bond yields fall and stocks rise. This correlative relationship between stocks, inflation, and bonds is sacrosanct and should never be ignored. Over long periods, stock and bond prices tend to react similarly to the same economic information. The true relation between stocks and bonds lies in their coupons, the amount of yearly returns you can expect to take out of each investment. Bond investors are intimately familiar with the notion of coupon. It is the amount the issuing entity, a corporation or government, pledges to pay each year as a percentage of the bond's par value. If a company issues a bond with a $1,000 par value and a coupon yield of 6.5%, the company has pledged to pay bond owners $65 a year, 6.5% of $1,000, until the bond matures. No matter how many times or at what price the bond changes hands in subsequent years, the $65 yearly coupon remains fixed. The yearly coupon payment never fluctuates, so a bond's value will be determined by three predominant factors. 1. The expected rate of inflation over the remaining life of the bond. 2. The prevailing yield on government bonds maturing at the same time. And 3. The risk premium bondholders demand based on their perceptions of the entity's financial stability. If bond investors expect inflation to reach 4% a year, they won't purchase a bond until it reaches a price that guarantees a yield to maturity of at least 4%. Otherwise, they would lose purchasing power. Common stocks offer their own form of coupon, the yearly earnings generated by the company. Whatever profits the company generates each year are legally owed to its stockholders. In most cases, however, the company retains profits and reinvests them to generate, you hope, higher earnings in the future. Thus, just as a bond possesses a yield to maturity, a stock has an earnings yield, according to Buffett, that allows you to compare it to bonds. As such, your goal in picking stocks is the same as that of a bond investor, to find an investment whose yearly returns, or coupons, more than compensate for inflation. Beyond that, you want to find stocks offering earnings yields that can beat risk-free government bond yields. This ensures that you can beat inflation and be adequately compensated for the risk of holding an instrument whose coupon is not assured. A bond pays you a set rate every year, whereas a company's earnings can fluctuate greatly from year to year. If a 30-year Treasury bond yields 6%, a company earning a fixed profit of $1 per share each year needs to trade for $16.67 to yield the same 6%. Presuming the company possesses some risk, investors should theoretically wish to value the company at less than $16.67 per share, which creates a higher yield. At a price of $12, the $1 in earnings would represent an 8.33% yield. At $14, the earnings yield is 7.14%. This direct relation between earnings, government bond yields, and stock price should hold in perpetuity so long as the company can generate $1 per share on shareholders' behalf each year. If yields on government bonds rise, the yield on the stock should likewise rise. The stock must fall to keep the earnings yield at parity with bonds. If government bond yields fall, one would expect the stock to rise to keep the coupon yield in sync with bond yields. Stocks are bonds with less predictable coupons. Think of a stock as a bond substitute, Buffett says, a dynamic security that has the capability of providing you less or more income each year than it did the preceding year. Whereas a bond's yearly returns are known and can be plotted exactly to maturity, a company's returns can, at best, be guessed. If you must buy a stock, Buffett says, make sure that the company's earnings coupons 1. Can beat inflation, 2. Can beat government bond yields, which are priced to reflect inflation, 3. Can rise over time. The third point is perhaps the most important. You should strive to improve the rate of return on your original investment. You accomplish this by acquiring stock in companies whose earnings yields increase over time. When earnings increase, the return on your original investment, the earnings yield, increases. The stock price will ultimately track the growth in coupon earnings. For example, consider a company that earns $1 per share, trades at $20, and is growing at 25% annual rates. By 2010, the company's earnings are providing a 46.6% return on the original investment, which is far in excess of inflation and the coupon returns of bonds. A 5% bond bought in 2000 would still return 5% in 2010. If interest rates never changed over that period, the price of the bond might stay fixed. The stock, however, is likely to surge in value. If the market continued valuing this company at 20 times earnings, a reasonable assumption, the shares would sell for $186.20 in 2010, an 831% return on the original $20 investment. The yearly earnings also would grow by 831% over the same period. As impressive as this earnings stream seems, investors could enhance their returns further if one of two events occurred. 1. Earnings growth accelerated above 25%, or 2. The stock dropped below $20. Either scenario results in higher coupon returns over time. The company's long-term returns would beat inflation by a wide margin in the first year, and one would guess all subsequent years. With such attractive returns possible, Buffett would gladly choose this stock over a bond, but this stock is not necessarily safe at any price. In fact, as the stock price rises, the coupon returns fall and become less attractive. Let's suppose the stock traded at $40 instead of at $20. Yearly coupon returns would be 1/2 as rich as before. In fact, the stock would not offer bond-beating returns for potentially several years. If bond yields stood at 6%, this stock would not offer a coupon yield that handily beat bond returns until 2005. As an investor, you would have to wait 5 years before the stock offered bond-beating results. Also keep in mind that this rate of return scenario hinges on the company's ability to increase earnings at 25% annual rates. If the company cannot sustain a high growth rate, you must temper the rate of return assumptions. Moreover, interest rates could rise to 7% and suddenly decrease the attractiveness of the company's earnings record. You could easily overpay for this company's coupon stream and experience inferior, perhaps negative, stock price returns. In Buffett's mind, you left yourself with little margin of safety. To be sure, the company's yearly coupons stand a good chance of eventually beating bond yields. As long as yearly profits keep rising, the company will present a potentially better investment opportunity than a fixed coupon bond can. If you could hold this stock for several years, you are virtually assured of bond-beating results, your original goal. But to better ensure success, focus as much on the price you pay for the stock as on the company's earnings stream. 6 rules for comparing stocks to bonds. In my previous book, Wall Street on Sale, McGraw-Hill, 1999, I devised a set of rules that allow you to place bonds and stocks in their proper context. Because this context is crucial to understanding Warren Buffett's methodology, I summarize these rules here. 1. Your overriding goal as a stock investor is to find companies whose returns can beat inflation. 200 years of market history have proven that stocks offer a nearly guaranteed means of beating inflation. 2. Your secondary goal is to beat the risk-free returns of government bonds, which are already priced to anticipate inflation. If the stocks you select cannot beat a bond return, you are better off putting your money into bonds. 3. The proper way of comparing a stock's potential return to a bond's return is to compare their respective coupons, that is, the money that can be generated on your behalf each year. When evaluating a bond, the relevant return is the yearly coupon. When evaluating a stock, the relevant return is the earnings you predict the company can produce each year going forward. 4. When possible, you should try to buy a stock whose current earnings yield, that is, current earnings divided by price, is near or above yields on a long-term bond. If interest rates are 6%, you need an earnings yield close to 6%. That is, the stock's P/E ratio should be at or under 17. If rates are 8%, you should look for companies priced at 12.5 times earnings or less. 5. The only time you should accept earnings yields that are lower than bond yields is when the company is growing and is expected to generate an earnings yield that would soon surpass bond yields. A high growth rate compensates for a low earnings yield, but the company's coupon yield should still compare favorably to a bond within a few years. If you must wait 5 years or more for earnings to catch up to bond yields, you are likely overpaying for the company. 6. Buying growth companies at the cheapest possible price is the best way to ensure that you can beat bond yields by a wide margin. You should try to take advantage of the compounding effect of earnings growth, which provides a higher and higher rate of return on your initial investment. Continuous growth in earnings leads to continuous growth in the return on your investment, which should lead to higher and higher share prices over time. Chapter 14. The Benefits of Avoiding Losses. Chroniclers of Buffett's achievements have commented that his sterling track record, when gauged from a rear-view mirror, seems relatively straightforward. Anyone with the patience, mathematical knowledge, and diligence to screen stocks could have roughly approximated Buffett's results, they say. Indeed, knowing what we know now, and having Buffett's entire career sliced and diced over 1,000 or more news articles, much of what he attained seems elementary in retrospect. Buffett would be the first to acknowledge that, although he possesses unusual mathematical gifts and is wired a little differently than most, thus permitting him to glean relevance from information others would overlook, the principles he applied could be mastered by virtually anyone with a grounding in finance. After all, how difficult can it be to find, say, a stock trading at 1/2 the value of its balance sheet cash, or a takeover deal that guaranteed a 50% annualized return, or a stock such as Coca-Cola trading at 12 times earnings, or a convertible preferred that could potentially double one's money within a few years? These types of situations, like lava from Mount Kilauea, bubble to the surface every day on Wall Street, waiting to be exploited by any investor who can find and understand them. Make no mistake, every great investor's motives, strategies, and results look crystal clear in retrospect. Peter Lynch's marvelous years running the Magellan Fund appear much less incredible judged from the skybox of history. He bought and sold common stocks like the rest of us, including many of the same types of stocks you probably placed in your own portfolio. Why, then, did Lynch attain vastly superior results? We tend to overlook the fact that the success of investors such as Lynch and Buffett derived from thousands of critical decisions they made over the course of decades, many of which were made on the fly, but the majority of which were correct. In our quest to find shortcut answers to how they did it, we tend to look at only the beginning, that Buffett started with $100, and at the end, his $30 billion fortune, and dismiss the daily rituals that got him from point A to point B. Those rituals, however, are what pushed Buffett's returns well above those of the crowd. If everybody had seen what he had seen, he wouldn't have made huge gains from his visions, Forbes magazine once wrote. A typical investor who spreads his or her money over a basket of stocks can expect to achieve 10 to 12% annualized gains over great periods. That's a well-known platitude. The same investor who focuses on the types of stocks Buffett owns, Coca-Cola, Gillette, Capital Cities, Wells Fargo, etc., could expect to gain perhaps a few percentage points more each year. These stocks have shown a tendency to outperform the market over long periods, because they exhibited growth rates greater than the average U.S. corporation. A shrewd, full-time investor who focused on Buffett-like stocks and made sure to buy them at wonderfully cheap prices could add a couple of extra percentage points of gain a year. But the combined effects of these strategies still don't come close to producing the 33% compounded annual gain Buffett attained between the mid-1950s and the late 1990s. There has got to be more to the story. The power of avoiding losses. Buffett once summarized the essence of successful investing in a simple quip. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Losses occur for 3 primary reasons. 1, you took bigger risks and exposed yourself to a higher probability of loss. 2, you invested in an instrument that failed to keep pace with inflation and interest rates. 3, you didn't hold the instrument long enough to let its true intrinsic value be realized. There aren't many ways an investor can avoid periodic losses. The best way is to invest all of your assets in bonds and hold them to maturity. You would, of course, experience an erosion in the value of the bond due to inflation. If interest rates rise during your holding period, the intrinsic value of the bond would fall, and the yearly coupon wouldn't fully compensate you for inflationary pressures. To reduce the chance of losses, you must minimize mistakes. The fewer errors made over your investing career, the better your long-term returns. We've already seen the advantage of adding extra points of gain to your yearly returns. Earning an extra 2 percentage points a year on your portfolio compounds into tremendous amounts. Beating the market's presumed 11% yearly return by 2 percentage points would translate into hundreds of thousands of dollars of extra profits over time. The same holds true if you can avoid a loss. When you lose money, even if just for a year, you greatly erode the terminal value of your portfolio. You consume precious resources that must be replaced. In addition, you waste precious time trying to make up lost ground. Losses also reduce the positive effects of compounding. The loser's game. It's a sad fact that most day traders lose money over time, as do most bond, options, futures, and commodities traders. Research has clearly shown that long-term returns are tied to your holding periods and to the price you pay. Excessive trading and disregard for fundamental risks serve as a weighty anchor that keep short-term oriented investors from consistently performing well. They strive so hard to compete at what are essentially zero-sum games that they unwittingly tax their performance into obscurity. Over time, their winning trades likely equal their losing trades, but they will continually lose a fraction of their money to taxes, commissions, and dealer spreads. Analyst and author Charles Ellis, in a 1975 article published in the Financial Analyst's Journal, was the first to label investing a loser's game. He foresaw how the field of investing, particularly at the institutional level, would ultimately degenerate into a momentum-based tournament where tens of thousands of individuals claw over one another trying to buy undiscovered stocks ahead of their peers. A game with so many participants, all trained to look at information the same way, would naturally tempt investors to make unforced errors, to borrow a term from tennis. Ellis neatly summed up his findings in a formula that showed how the pursuit of market-beating gains naturally led to inferior returns among fund managers. To beat the market, fund managers first had to beat each other and had to increasingly engage in short-term momentum trading to do so. Ultimately, these managers predetermined their own poor results and occasionally caused huge losses. Ellis concluded that the most successful investors are not necessarily the smartest people or those with million-dollar research budgets. Nor are they the ones who luckily scored 1,000% gains on a single stock. Rather, they are the ones who make the fewest mistakes during their careers. The belief that active managers can beat the market is based on two assumptions. 1. Liquidity offered in the stock market is an advantage, and 2. Institutional investing is a winner's game. My unhappy thesis can be briefly stated. Owing to important changes in the past 10 years, these basic assumptions are no longer true. On the contrary, market liquidity is a liability rather than an asset, and institutional investors will, over the long term, underperform the market because money management has become a loser's game. Golf provides an excellent example of a loser's game. The winner of a PGA tournament on Sunday is not necessarily the longest hitter, the best putter, nor has the best short game. The winner is the one who makes the fewest mistakes during the 4 rounds. That fact alone differentiates golf from most contact sports such as football or hockey. In contact sports, and even in tennis, the outcome of the game is determined by the winner, who presumably overpowers the opponent with skill and muscle to score the most points. In golf, the actions of the loser determine the outcome. Tiger Woods wins tournaments mostly because all his opponents, who never compete directly with Tiger during the weekend, make more mistakes than he does. Tiger could shoot 10 under par and lose the tournament if one of the 64 other players happens to make fewer mistakes and shoots 11 under par. The final outcome is really outside Tiger's control. He must rely on others to make more mistakes on the fairways than he does. Bowling operates under similar rules of engagement. Each contestant starts with a theoretical perfect score of 300 and loses points as more pins are missed. The final outcome of the match is determined by the loser, the person who misses the most pins. If you understand the rules of losers' games, you have taken a critical first step toward success in investments. Warren Buffett sits atop the financial world because he has made the fewest mistakes over his 40-year career. His most common mistakes, he admits, are sins of omission in which he failed to buy a stock that rallied or sold a stock too soon. Neither type of mistake cost Buffett cash. They are simply lost opportunities. If I polled 1,000 investors and asked them to list their top 5 rules for success, their answers would differ from Buffett's. Here is what they would probably say. Rule 1, take a long-term perspective. Rule 2, keep adding money to the market and let the magic of compounding work for you. Rule 3, don't try to time the market. Rule 4, stick to companies you understand. Rule 5, diversify. I would venture to say that few investors would think to mention Buffett's cardinal don't lose money rule. Some investors, sadly, refuse to believe that losses can occur, so accustomed are they to the unprecedented rally in the major indexes since 1987. Surveys done by mutual fund companies during the past few years indicate that a high percentage of individual investors still don't believe that mutual funds can lose money or that the market is capable of dropping more than 10% anymore. Other investors see losses as temporary setbacks or as opportunities to add to their positions. Still others, acting out a psychological defense mechanism, try to avoid losses by violating their own rules. They let the ticker tape infect decision-making and trade in and out of winners and losers to avoid the psychological trauma of having to report a loss. Avoiding losses is probably the most important tool for long-term success in investing. No investor, even Buffett, can avoid periodic losses on individual stocks. Even if you resigned yourself to buying only at incredibly cheap prices, occasional mistakes will still occur. What differentiates Buffett from nearly all other investors is his ability to avoid yearly losses in his entire portfolio. Diversification alone can't prevent losses. All diversification can do is minimize the chances that a few stocks implode and drag the performance of the portfolio with them. Even if you hold 100 stocks, you are forever vulnerable to market risk, the risk that a declining market causes nearly all stocks to drop together. Most investors use the market as their mechanism for avoiding losses. They simply sell when a stock falls below its break-even point, no matter the fundamentals. One highly touted strategy of the 1990s, espoused by Investors Business Daily, implores investors to sell any issue that falls more than 8% below its purchase price, irrespective of events. Market timers rely on similar strategies. They make short-term bets on the direction of individual stocks and are prepared to exit quickly if the market turns against them. These strategies ultimately degrade into a form of gambling, where the odds of success shrink because the investor's holding period is too short. Other investors avoid losses by continuing to hold poor-performing stocks, sometimes for years, until they rally back above their original cost. To profit from this strategy, you must pin your hopes on the markets ultimately validating your decision. Warren Buffett would rather not place his faith in the hands of investors and traders. The methods he uses to lock in yearly gains take the market out of the equation. He reckons that if he can guarantee himself returns, even in poor markets, he will ultimately be way ahead of the game. Chapter 15. Avoiding Losses 2. Market Timing, Convertibles, and Options. Keeping abreast of market conditions. Again and again, Warren Buffett will tell you that he is not concerned about day-to-day fluctuations in the stock market. It doesn't matter to him whether the Dow Industrials rises 300 points in a single day or falls by the same amount. He doesn't care whether interest rates rose or fell for the day, or whether his portfolio declined $200 million in value. A frequent occurrence in 1999, by the way. The market is there only as a reference point to see if anybody is offering to do anything foolish, he was quoted saying in 1988. When we invest in stocks, we invest in businesses. However, Buffett, whether by accident or calculation, must be recognized as one of the most astute market timers in history. His ability to sense great perils in the market or see great opportunity when others see peril sets him apart from even the legendary market timers such as George Soros or Michael Steinhardt. It is also a chief reason he rarely suffers a yearly loss in his portfolio. His ability to find bargain stocks is well documented. Less known is his success in gauging market conditions and profiting from them. When Buffett begins talking up or down the market, it pays to listen. His form of market timing is similar to Wayne Gretzky's approach to hockey. Don't go where the puck is, go where it's going to be. The great investors of the 20th century all seemed to have a penchant for discovering undervalued securities, but they also were forward-looking. When a recession was underway, they didn't brood. They looked for signs that a recovery was at hand. And when the economy was strong, they stayed mindful of the risk of a slowdown and planned accordingly. When playing the market, they looked for catalysts that could propel an industry ahead, even when Wall Street had turned negative on the sector. Conversely, they wouldn't wait for boom times to end, but would sell ahead of others. Warren Buffett owes his success through the years as much to what he didn't buy as to what he did. Likewise, what he sold, and when he sold it, played just as prominent a role in his returns as did decisions to buy and hold Coca-Cola, Geico, or Gillette. Whitney Tilson of Tilson Capital Partners in New York, a frequent columnist to the Motley Fool website, reminds us that Buffett made no fewer than 4 distinct market timing calls in his career, each of which proved correct and highly profitable. Market Call 1. Selling out before the early 1970s bear market. Beginning in 1968, Buffett began to express sincere worries over stock prices. Writing near the peak of the go-go market of the 1960s, Buffett seemed to sense imminent danger to investors. Unable to find enough quality stocks at reasonable prices, he folded his investment partnership in 1969, acknowledging that his form of diligent, research-intensive stock picking couldn't compete in a momentum-fed, short-term-oriented market. Spectacular amounts of money are being made by those participating in the chain-letter-type stock promotion vogue. He wrote his clients, "The game is being played by the gullible, the self-hypnotized, and the cynical. I believe the odds are good that when the stock market and business history of this period is being written, this phenomenon will be regarded as of major importance and perhaps characterized as a mania." Frustrated by the lack of sensible pricing and the inability of value-oriented managers to make headway amid a sea of momentum-hungry fund managers, Buffett liquidated clients' accounts, put most of his personal wealth into Berkshire Hathaway stock, and stayed mostly out of the money management business for almost 5 years. He stayed on the sidelines while Americans experienced the most brutal bear market since the crash of 1929 to 1933. Market Call 2. Going long in 1974. 5 years after the market had peaked, most Americans had turned disillusioned by the stock market. The average portfolio had dropped 40% or more in value. Investors holding the great blue chips of the day, Xerox, Walt Disney, IBM, General Motors, and Sears Roebuck, for example, saw their portfolios decline more than 60% during the crash of 1973 to 1974. To investors caught in the middle, it seemed like there was no end to the panic selling. Some individuals tried holding their stocks, waiting for a rebound that never took place. Exhausted, they gave in and sold after watching their portfolios lose 50% of their value. The rest took their cues from the market itself. Daily declines reinforced a selling mentality. Selling begat selling, and an orderly market turned into a vicious cycle of losses. At the bottom, in 1974, few investors could be coaxed to re-enter the arena. But Buffett, refreshed from a 5-year hiatus and sitting on plenty of cash, dove headlong into the same stocks the market could no longer tolerate. Like a boy in a candy store, Buffett found more values than he could possibly digest. An investor who plunged into the market at the 1974 low made a 74% return within 2 years. Market Call 3. Seeing the opportunities that would open up in the 1980s. By 1979, the Dow Jones Industrial Average traded no higher than it did in 1964, 15 years without a single point gain. Pessimism hit extreme levels. The public had gradually shifted their portfolios into bonds, real estate, and precious metals, and brokers found it difficult to peddle even stocks with 15% dividend yields. Leading market strategists of the day, predicting more of the same financial morass, implored investors to buy bonds and avoid stocks. Buffett saw things differently. From his perspective, quality blue-chip stocks were being given away. Some sold for less than their book values, despite the fact that economic prospects for the United States still appeared bright. Corporate returns on equity remained healthy, blue-chip earnings were advancing at double-digit rates, and the speculative frenzy that had destroyed the integrity of the late 1960s markets had finally been removed from the equation. Stocks now sell at levels that should produce long-term returns superior to bonds, he told shareholders. Yet pension managers, usually encouraged by corporate sponsors that must necessarily please, are pouring funds in record proportion into bonds. Meanwhile, orders for stocks are being placed with an eyedropper. How right Buffett was. As Tilson pointed out, the stock market has returned an annualized 17.2% since Buffett penned those words. Bonds returned 9.6%. Market Call 4. Avoiding the 1987 crash. By the mid-1980s, Buffett's buy and hold philosophy had been carved in stone. He maintained large stakes in his 3 favorite companies, Geico, Washington Post Company, and Capital Cities ABC, which later merged with Walt Disney, and pledged to hold these inevitables, as he called them, forever. He didn't share the same convictions about the rest of the stock market. At the Berkshire Hathaway annual meeting in 1986, Buffett lamented that he could not find suitable companies trading at low prices. Rather than dilute his portfolio with short-term stock investments, and given the fact that Buffett's stock holdings had already provided him tens of millions of dollars in gains, Buffett opted to take profits and shrink his portfolio. "I still can't find any bargains in today's market," he told shareholders. "We don't currently own any equities to speak of." Just 5 months before the 1987 crash, he told shareholders of his inability to find any large-cap stocks offering a high rate of return potential. "There's nothing that we could see buying, even if it went down 10%. In retrospect, Buffett's comments about a 10% decline ultimately proved conservative. 5 months after telling shareholders of his dilemma, the stock market lost 30% within a matter of days. His decision to whittle away his portfolio slowly before the crash undoubtedly kept Berkshire's stock portfolio from imparting too big a negative influence on book value. Buffett entered the 1980s energetic, ready to dive into a market he saw as woefully underappraised. As the market rose in value without pause, Buffett's conservatism got the better of him. By 1987, he was holding large stakes in just 3 stocks. When the decade began, Buffett had amassed large positions in 18 different companies. Warren Buffett does not possess a magic formula for determining when the stock market is grossly overvalued or undervalued. By all accounts, his decisions to plunge into or escape from the market are based on several common-sense factors. The relationship between stock yields and bond yields. Recall from Chapter 13 that Buffett covets stocks that offer earnings yields that can surpass bond yields over time. When bond yields are rising and threaten to overtake stock yields, the market is generally overvalued. When stocks fall to the point where their earnings yields, the inverse of P/E ratios, are above bond yields, they are most attractive. The rate of climb in the market. History tells us that the stock market cannot outperform the economy for very long. That is, you shouldn't expect corporate sales, earnings, or share prices to rise at rates in excess of economic output. If stock prices are rising at, say, 4 times the rate the economy is expanding, the market is primed for a fall at some point. Conversely, if stock prices are falling while the economy is surging, an undervalued condition may be opening up. Earnings multiples. In 1982, the P/E ratio of the S&P 500 index was just 7. Americans were willing to pay just $7 for every $1 corporations earned on their behalf. By mid-1999, Americans were willing to pay $34 for every $1 of earnings generated by these same companies. What explained the disparity? Falling interest rates accounted for some of the increase in P/E ratios. Declining rates make every $1 of earnings worth more to an investor. Improved profitability also accounted for some of the increase in P/E. By the late 1990s, corporate returns on equity and assets had reached 70-year highs. It stood to reason that $1 of earnings carried more value because corporations could reinvest earnings at high rates. Yet the majority of the climb in stock prices can be attributed to emotion, the sheer willingness of investors to pay higher and higher prices without regard to value. When P/E ratios are expanding faster than what could be expected, given changes in interest rates and corporate profitability, investors must be on the alert for a correction. The state of the economy. When the economy is running full throttle and there seems to be little chance of it sustaining present growth rates, investors should ponder whether to decrease their exposure to the stock market and find alternatives. Likewise, during tough economic times, stocks usually fall to bargain levels and offer high rate of return potential. Using Buffett's 15% rule, you can quickly gauge whether stocks are worthy of holding. The general rule is to buy during a recession, when P/E ratios are at their lowest, and to sell when the economy can't get any stronger and P/E ratios are their highest. The big picture. Because Buffett endeavors to hold a stock for several years or more, he must take a more holistic view of companies, industries, and the entire market before buying. Buffett won't buy or sell a stock in response to near-term changes in a company's profitability, nor will he pin his hopes on a sector catching fire on Wall Street to sell at a higher price. Instead, he assesses longer-term fundamentals in the economy and the market and examines whether those fundamentals can support higher stock prices. If a stock doesn't offer the potential rate of return he seeks, he is likely to sell the security or avoid buying. Buffett prefers to play an economic cycle to the fullest whenever possible. During a recession, when nearly all U.S. industries are experiencing a downturn, Buffett is apt to load up on numerous stocks, knowing that several consecutive years of improved profitability lie ahead. When the economy peaks and odds favor an eventual slowdown, selling is the prudent course. Convertibles. Some of Buffett's most lucrative investments in the late 1980s and early 1990s involved convertibles, which are hybrid securities that possess features of a stock and an income-producing security such as a bond or preferred stock. He made 5 publicized convertible investments starting in 1987, Salomon Brothers in 1987, Gillette in 1989, American Express in 1991, Champion International in 1989, and U.S. Air Group in 1989. Combined, the 5 convertibles have provided more than $5 billion in gains and prompted Buffett to take larger stakes in 3 of the companies. He still holds all the common shares of Gillette and American Express that converted, and dovetailed his Salomon Brothers investment to obtain large stakes in Travelers Group and Citigroup. When you buy a convertible issued by, say, Gillette, you get a fixed income stream, just as you would with a bond, but you also possess the right to convert your bond into a fixed number of shares of common stock. The conversion feature makes these investments most attractive, despite the fact that the convertible price is usually 15 to 25% above the common stock's price, and the coupon rate on the bond is usually below prevailing bond rates. Say you pay $1,000 for XYZ Corporation's bond and have the right to convert it to 20 shares of XYZ stock, a conversion price of $50 per share. XYZ shares sell for $40 each. Multiply $40 by 20 and you get $800. You're paying a premium of $200. The income component, whether in the form of a bond coupon or a preferred dividend, defrays the premium paid. With a convertible, you're betting on the appreciation of the common stock to kick up your returns. If XYZ's shares rise to $50 or above, the convertible is said to be in the money. $50 per share times 20 shares equals $1,000. Each $1 advance in the common stock should lead to $1 increases in the value of the convertible. You can choose to convert and sell your common shares for a profit. You also have the option of converting but holding on to your common stock, or letting profits ride by holding the convertible. Because there is a bond component to the security, a convertible shouldn't decline as much as the common stock. Theoretically, the security won't fall below the face value of the underlying bond, no matter how low the common stock drops, unless the company faced financial distress. Buffett will invest in convertibles when the combination of dividends and stock appreciation potential offers a market-beating return. Under almost any conditions, we expect these preferreds to return us our money plus dividends, he wrote in his 1989 annual report. If that is all we get, though, the result will be disappointing because we will have given up flexibility and consequently will have missed some significant opportunities elsewhere. The only way Berkshire can achieve satisfactory results from preferred issues is to have the common stocks of the investee companies do well. Options. On a number of occasions, Buffett has expressed his disdain for derivative securities such as futures and options contracts. Because these securities are bets on shorter-term price movements within a market, they fall under the definition of gambling rather than of investing. An investor in a put or call option, for example, is making a timing bet on the near-term direction of a stock and is trying to magnify the gains through leverage, that is, not having to put up the full amount. For example, an investor who thinks that shares of America Online, priced at $50, will rise, may buy a call option with a strike price of $50. That gives him the right to buy the stock from the option seller for $50 per share, regardless of America Online's price at the time, before the options contract expires. Let's say the investor paid a premium of $5 for the right to exercise this option. His total outlay is $500, each contract covers 100 shares, that he cannot recover. If America Online rises above $55, the $50 strike price plus the $5 premium paid, by expiration, the contract will make money. Should the stock reach $60, the option would be valued at $10, $60 minus the $50 strike price, a doubling of the investor's principal. At a price of $70, the option is worth $20. All it took was a 16.6% increase in the stock to cause a doubling of the option's value. An investor in a put option attempts to do the opposite. Rather than obtain the right to buy the stock at a fixed future price, the put buyer wants the right to sell the stock at a later date and seeks to lock in the price up front. He'll pay a premium for the right to sell the stock that will make money if the stock falls enough to more than cover the cost of the premium. If Warren Buffett does dabble in options, and if you doubt he could dabble successfully, he does so quietly. He once acknowledged writing put options on Coca-Cola's stock. At the time, he was thinking of adding to his stake in the soft drink company. This occurred in April 1993 when Coke stock hovered around $39 per share before splits. Buffett was out to acquire several million more shares of Coca-Cola. He already owned 93.4 million shares, but was fearful that the stock would rally and run away from him. He wrote puts covering 5 million shares at an exercise price of $35. Buffett collected a $7.5 million premium, $1.50 per option. By using options, Buffett was attempting to get more shares of Coke on the cheap, and in the process collect a premium to defray his costs. It worked this way. If Coca-Cola's stock crashed before the option expired, the buyers would put the stock to Buffett, forcing him to take 5 million Coke shares off their hands for a net price of $33.50 per share, the $35 strike price minus the $1.50 premium. That suited him fine because he wanted the shares anyway and hoped they would fall in price when it came time to buy. However, had Coke stock risen in price, the buyer would have let the option expire worthless. No stock would have changed hands, but Buffett would have pocketed the $7.5 million premium, which is exactly what happened. The stock rose past the point at which Buffett wanted to buy, and he walked away with $7.5 million, but knowing that he did not overpay for Coca-Cola. Buffett would have to wait another year for the chance to buy Coca-Cola again. In 1994, he increased his then 93.4 million share stake to an even 100 million, which split in 1996 to become 200 million. This was the only time the press has made note of Buffett's foray into options, although he probably has used options numerous times in his career. It's likely he hedges future purchases of stock by selling put options ahead of his purchase. This gives him a locked-in premium and a chance to buy his favorite stocks while they are in decline. Mathematically speaking, the use of options in trying to obtain Coca-Cola stock represented a win-win situation for a value hunter such as Buffett. It would not be surprising to learn that Buffett tries to obtain many of his new stocks in this manner. Chapter 16. Warren's Secret Weapon. Arbitrage. Given the secrecy surrounding Buffett's early career and the scant press attention paid to his activities, few understood just how this young, waggish crew-cut figure from Omaha consistently beat the Dow Jones Industrial Average. Buffett's chums from the Graham School of Investing knew, of course, that the market was beatable, not just because Graham said it was, but because some of them were proving it with their own money. But the outside world, with nothing more to go on except the efficient market dogma that crept into business schools, could ascribe Buffett's year-after-year successes to nothing more than chance. It's as if they secretly wished that the Nebraska prodigy would stumble one year to prove his mortality and the market's invincibility. It didn't happen. Not only did Buffett continue to beat the major market averages, but he suffered few single-year declines along the way. That second accomplishment is by far the more remarkable. Statistics tell us that any investor who buys and sells hundreds of stocks over a period of decades and leaves himself vulnerable to the near-term vagaries of the market has a perfect 100% chance of posting some yearly losses. It stands to reason that no matter how well chosen one's portfolio, profits will be vulnerable to factors outside the investor's control. On October 19, 1987, when the Dow Industrials fell 508 points, more than 97% of all stocks fell in price. Perhaps 1 in 1,000 ordinary investors made money that day. Perhaps 1 in 10 made money the whole year. Because the market has a tendency to fall once every 4 years or so, an average investor can expect 10 yearly losses over a 40-year period. A great investor might be able to reduce the number of yearly losses to 5 or 6. Buffett's scorecard shows that he has increased the book value of Berkshire Hathaway stock 35 consecutive years. In only 4 years did the S&P 500 index beat the growth of Berkshire's equity. This is similar to 40 years of par golf or better. There are only 3 ways an investor can attain a long-term, loss-free track record. 1. Buy short-term treasury bills and bonds and hold them to maturity, thereby locking in 4 to 6% average annual gains. 2. Concentrate on private market investments by buying properties that consistently generate higher profits and that can sell for greater prices each year. 3. Own publicly traded securities and minimize your exposure to price fluctuations by devoting some of the portfolio to unconventional, sure things. Stringing small gains together with takeovers. Right from the start of his investment management career, Buffett resorted extensively to takeover arbitrage, the trading of securities involved in mergers, to keep his portfolio results positive. In poor market years, arbitrage activities have greatly enhanced Buffett's performance and kept returns positive. In strong markets, Buffett has exploited the profit opportunities of mergers to exceed the returns of the indexes. Benjamin Graham, Buffett's mentor, had made arbitrage one of the keystones of his teachings and money management activities at Graham-Newman between 1926 and 1956. Graham's clients were informed that some of their money would be deployed in shorter-term situations to exploit irrational price discrepancies. These situations included reorganizations, liquidations, hedges involving convertible bonds and preferred stocks, and takeovers. One of Graham's first investments was a classic arbitrage. In 1915, at the age of 21, he bought shares of Guggenheim Exploration Company, a holding company priced at around $69 per share. Guggenheim owned minority stakes in 4 copper mining companies: Kennecott, Chino Copper, American Smelting, and Ray Consolidated. The Guggenheim stakes combined were worth more than $76 per share. Therefore, on paper, an investor was getting $76 worth of assets for just $69. Graham reckoned that the situation could not continue indefinitely because Guggenheim stock had to rise to at least $76, which would give him a locked-in $7 per share profit. The word arbitrage in the strict sense refers to the simultaneous buying and selling of a security, or related security, in 2 different markets to capture irrational price movements. For example, if Hewlett-Packard stock was selling for $80 on the New York Stock Exchange and for $82 on the Pacific Stock Exchange, an arbitrageur would buy all the Hewlett-Packard stock he could get his hands on in New York and make arrangements to sell it on the Pacific Exchange, locking in a $2 profit each time. The rub is that these opportunities, when they arise, don't last very long. Systematic purchases of Hewlett-Packard stock in New York would drive up the price on that market, while concurrent selling on the Pacific Exchange would drive Hewlett-Packard's quote down. Both markets would quickly reach parity again. takeover arbitrages operate in roughly similar ways. In effect, you are trying to capture the spread between the market price of a stock and the deal price. That is, the price at which one company has agreed to pay for another. Merck, for example, might offer $85 per share in cash to buy Pfizer. If Pfizer's stock trades at, say, $80, an investor has the opportunity to lock in a guaranteed $5 profit by buying Pfizer and holding his shares until the deal is approved and then tendering them to Merck. The $5 profit represents a 6.25% gain on your $80 investment. If Pfizer's stock dropped below $80, the potential gain widens. The trick in takeover arbitrage is to maximize your annualized gain and minimize your chances of loss. Companies usually disclose up front how fast they think they can consummate the merger, which has a big impact in determining your returns. In the Merck example, a $5 profit translates into a 12.9% annualized gain if the deal closes exactly 6 months after your purchase. If the deal closes in 4 months, your annualized gain turns into a more attractive 20%. Once the deal closes and you have received your money from Merck, deploy the proceeds into another deal offering similar profit opportunities. By stringing together a succession of arbitrage trades, an investor can turn small percentage gains on each transaction into huge annual gains, providing all the deals work in your favor. If you can make 10% on consecutive deals that close in 3 months, your compounded return, assuming you reinvest all the profits from the previous deal, will be an astounding 46.4% for an entire year. There's no shortage of these opportunities. Between 10 and 20 mergers are announced every day on Wall Street, some of which have opened up fabulous profit-making bonanzas for investors sharp enough to spot them. Buffett has spoken sparingly of his arbitrage activity, except to say that he does it, especially when he has trouble finding good bargains, continues to do it, and has done pretty well at it. Truth be told, there are more than a few investment advisors behind bars for attaining, however illicitly, the gains Buffett scored legally playing takeovers. Buffett wrote that Graham attained a 20% annual return from arbitrage activities between 1926 and 1956, a result that would have destroyed the returns of the Dow Industrials. In 1988, Buffett claimed that his own returns from arbitrage to date had averaged well over Graham's 20%. While running his private partnership in the 1950s and 1960s, Buffett invested in arbitrage situations dozens of times. He recognized the superior returns possible from stringing together small percentage gains over and over. Most important, Buffett seems to have used arbitrage to protect his clients' portfolios from the vagaries of the stock market. By putting a large portion of their money into takeover situations, what Buffett routinely called workouts, he could reap abnormal gains without worrying about the general conditions of the market. Indeed, in a poor market, Buffett could expect his arbitrage positions to gain in value, or at least not decline. Knowing that he could insulate a good portion of clients' portfolios from losses, Buffett was free to concentrate the rest of their holdings into just a few stocks. Writing to his clients in February 1960, Buffett said that 35% of their money was tied up in one stock, which he declined to name. The rest was invested in undervalued stocks and workouts. To the extent possible, I continue to attempt to invest in situations at least partially insulated from the behavior of the general market. In general, workouts constituted the second largest component of Buffett's partnership portfolios. Whereas Buffett rarely told investors about the types of arbitrage situations he played, he openly acknowledged the volume of deals he transacted and that he borrowed money to make purchases. In 1990, Forbes unearthed financial filings made to state regulators by Berkshire Hathaway's insurance subsidiaries, in an attempt to stitch together Buffett's yearly arbitrage activities. They sought out insurance records because Berkshire's insurance companies provide most of the cash Buffett needs to make new investments. Forbes found, for example, that Buffett used takeover arbitrage extensively in 1987 to keep Berkshire's investment portfolio rising in a highly volatile market. Interestingly, Buffett was significantly cutting the number of common stocks Berkshire held in its portfolio. Thus, at a time when ordinary investors were losing money on common stocks, Buffett was relying heavily on non-traditional investments to stay in the black. That year, Buffett played takeovers involving Kraft, RJR Nabisco, and Philip Morris, in addition to lesser-known companies such as Marine Midland, Federated, and Interco. He turned a $2.7 million bet on Southland into $3.3 million in 10 days for an annualized gain of more than 700%. In all, Forbes estimated that Buffett's arbitrage activities earned 90% in 1987, whereas the S&P 500 returned 5%. In 1988, Buffett bet on 20 different takeovers, netting a gain of 35%, more than twice what the S&P 500 gained. The following year, Buffett was not as fortunate, Fortune magazine reported. He lost 31% on takeover deals. He did not reveal this loss to shareholders, but had warned them the previous year that he planned to take fewer arbitrage stakes in 1989 because of extraordinary excesses in the takeover arena. The less the prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs, he wrote. Nevertheless, that year Buffett tendered part of his arbitrage stake in RJR Nabisco to take over specialists Kohlberg, Kravis, Roberts and Company, and sold the rest of his shares in the market for a combined $64 million profit. The Rockwood Cocoa Bean Bonanza. In 1954, his first year working for Graham, Buffett plunged into one of the more offbeat of his numerous arbitrage trades, and one of the few about which he has spoken freely. Rockwood and Company, a barely profitable chocolate maker, found itself in a squeeze when the price of cocoa temporarily soared tenfold, and the company tried to liquidate its inventory for a profit. The catch was that Rockwood faced a nearly 50% income tax on the sale. Luckily, that same year, the Internal Revenue Service allowed companies to avoid taxes on inventory sales if they sold their material to shareholders as part of a restructuring of the business. Taking advantage of the rule change, Rockwood announced it would sell its cocoa butter business and assigned 13 million pounds of beans to that division's inventory. As part of the deal, Rockwood announced it would repurchase stock from shareholders and give them 80 pounds of beans per share. With cocoa beans selling for 60 cents a pound, Rockwood was essentially repurchasing stock at $48 per share. Just before the announcement, Rockwood stock traded for just $15. Buffett seized the opportunity. He bought Rockwood shares on the open market, sold the shares back to Rockwood, and then sold beans he received in the exchange and used the proceeds to purchase more Rockwood shares. This enabled Buffett to profit continuously until the spread between bean prices and Rockwood's stock price evaporated. For several weeks, I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good, and my only expense was subway tokens, Buffett said. General Dynamics. One of Buffett's most profitable investments on a dollar basis resulted from a routine arbitrage deal that turned to gold. In July 1992, defense contractor General Dynamics, then in the midst of a restructuring, announced that it would repurchase up to 30% of its stock in a Dutch auction at prices between $65.37 and $72.25 per share. General Dynamics has since split 2-for-1 twice. In previous months, the company had sold off 3 of its non-defense-related divisions, Data Systems, Cessna Aircraft, and Hughes Aircraft, and had raised $1.25 billion. As the U.S. military was gradually paring down and reducing orders to contractors, General Dynamics opted not to plow the $1.25 billion in proceeds back into the company. Instead, it made a bold move to reduce the number of shares outstanding and substantially raise per-share earnings for investors who wouldn't tender. Sensing an opportunity to make a few dollars profit, Buffett, buying through Berkshire Hathaway, accumulated 4.3 million shares of General Dynamics at prices averaging $72, $18 post-split. I had paid little attention to the company until last summer, when it announced it would repurchase about 30% of its shares, Buffett wrote in his 1992 annual report. Seeing an arbitrage opportunity, I began buying the stock for Berkshire, expecting to tender our holdings for a small profit. It was only after purchasing the shares that Buffett began studying General Dynamics and saw the unique turnaround being engineered by CEO William Anders. Anders had been wringing tens of millions of dollars of costs out of the company's operations by laying off several thousand employees, closing manufacturing facilities, and slicing research and development expenditures. Wall Street seemed elated with Anders' moves. General Dynamics stock had more than doubled off its bottom before the company announced the Dutch auction. Still, the stock traded below the company's book value, a point that caught Buffett's attention. Rather than tender his 4.3 million shares, Buffett hung on, believing that the stock had further rallying power. Over the next 5 years, the shares Buffett continued to hold would nearly quadruple in price. In addition, General Dynamics declared 3 special dividends in 1993 amounting to $50 per share, $12.50 post-split. Buffett's 4.3 million share purchase would have turned into 17.2 million shares after the splits, but Buffett sold 20% of his stake in April 1994 and then another 14% stake in August. He disposed of another 20% over the next 2 years. By 1998, Berkshire Hathaway held 7,693,637 shares of General Dynamics that at one point were worth about $530 million. The $50 per share dividends Buffett received and his pre-tax profits, including profits from shares sold between 1994 and 1997, totaled an estimated $450 million by mid-1999. "We were lucky," Buffett acknowledged after the fact. Buffett is by no means alone in what he does. Hundreds of professional investors worldwide make their living speculating on stocks involved in takeovers. They do little else but sit at terminals and watch news wires for announcements of a takeover. When one flashes across their screen, they quickly analyze the deal, form a strategy, and act. They may close the position within hours or days, depending on their goals. Some arbitrageurs will hold their stocks until the deal is consummated and they receive their cash or shares. From all indications, however, none has been as successful at capturing returns from deals as Buffett because he focuses only on sure-thing deals, which these days represent a smaller and smaller fraction of the mergers announced. Buffett also has the luxury of patience on his side. ARBs, in contrast, need to justify their existence by trading. They tend to react quickly to as many deals as possible, sometimes before the companies release all the details of the merger. Buffett, however, picks and chooses a few deals a year from among hundreds already announced. He is more likely to research the deal thoroughly and wait for a temporary dip in the target stock to lock in a guaranteed high return. Buffett also differs from other ARB specialists in that he almost always enlists on the side of the common shareholder. He takes positions after mergers are announced, rather than use his clout and financial backing to force deals to occur, which was typical of takeover specialists in the 1980s. He never invests based on rumored takeovers either. Buffett's cardinal goal is to profit from the spread in price, not to take a controlling interest in the company and force a turnover of management. Nor is he interested in acquiring properties for the sake of busting them up into pieces. His role, as he sees it, is merely to exploit the attractive mathematics these deals offer. The deal itself is of no consequence to Buffett because he rarely cares about the companies in play. He simply senses opportunities for abnormal profits and pounces. Buffett's thoughts on forming good habits. I don't think you can be a really good investor over a broad range without doing a massive amount of reading. You might think about picking out 5 or 10 companies where you feel quite familiar with their products, but not necessarily so familiar with their financials. Then get lots of annual reports and all of the articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself. And when you get all through, ask yourself, what do I not know that I need to know? Many years ago, I would go around and talk to competitors and employees. I just kept asking questions. It's an investigative process, a journalistic process. And in the end, you want to write the story. Some companies are easy to write stories about, and other companies are much tougher to write stories about. We try to look for the ones that are easy. I consider there to be 3 basic ideas that, if they are really ground into your intellectual framework, I don't know how you could help but do reasonably well in stocks. None of them are complicated. None of them take mathematical talent or anything of the sort. Benjamin Graham said you should look at stocks as small pieces of the business. Look at stock fluctuations as your friend rather than your enemy. Profit from the folly rather than participate in it. And Graham said the 3 most important words of investing: margin of safety. I think those ideas, 100 years from now, will still be regarded as the 3 cornerstones of sound investing.